Welcome back to the Dividend Diplomats YouTube channel, where you're rolling with Bert and Lanny, the Dividend Diplomats. And guys, we're diving into the real estate investment trust right now, aren't we, Bert?
That's right. But before we dive in, everybody, you know what you need to do. Join the community, smash that subscribe button, give us this thumbs up. Everybody, we've been loving all the engagement on Twitter, on all of our YouTube videos recently, and even the YouTube community feature where we're getting a lot of great feedback, a lot of great stock ideas, and just your thoughts instantly. So thank you, everybody, for the support. Let's keep it going. Let's keep sharing the word of dividend growth investing and reaching financial freedom.
Guys, it's no joke now. We're heading into possibly recession coming up here in the next week, the official announcement. Obviously,
you think this is funny, Lanny? Nothing's funny.
You think it's a game? You think it's a bleep game? Well, guess what, guys? But we're still investing. We're still looking for dividend stocks. I know REITs are very popular right now, especially because they are higher yielding. And as Series I bonds are doling out over 9% to compete with inflation over 9%, we wanted to showcase three high dividend yielding REITs here on this channel. But Bert, what's your favorite piece, or what are your thoughts on REITs in general?
I mean, if you think about REITs, there's potential chance for everyone to get some great value with some high yield because of how the structure of REITs are set up. They're very levered, so they take on a lot of debt. So there's a lot of debt on those balance sheets. So as interest rates continue to rise, it becomes more expensive to borrow. Each one of the REITs' interest expense increases, so the value goes down because their financials aren't as strong historically because you're paying a higher interest expense. That being said, it's just interest expense. Rents go up. Everything else goes up in the business too. And the well-managed REITs can provide some great value to investors right now and a nice yield and present some great buying opportunities.
Exactly. There could be some great opportunities. Obviously, more than likely, the owners would pass on the increases to their tenants when those leases are coming due, aka they stand to at least make up some ground on the higher costs that they may be going through.
Yeah, so the well-managed REITs have been expecting interest rates to go up at some point. I mean, you would assume that. So you would assume that they're prepared for this because interest rates weren't going to stay historically low forever. May not have forecasted them increasing this quickly, but nonetheless, that's the REIT sector right now. So we're excited to dive into these three high yielding REITs. Lanny, you want to run through the metrics of how we're going to look at these REITs?
Sure. Obviously, it's a little bit different, guys. We strip out the earnings per share and we toss in the adjusted funds from operation per share, or for one, just the funds from operations per share, because they don't report AFFO anymore. We look at that, price to that ratio, the dividend payout ratio with the AFFO. We look at the history of dividend growth. And guys, we're looking at three REITs that are between 2 billion and 15 billion in market cap. So no, we're not talking about your realty income. We're not talking about your store capital, et cetera, et cetera. We are not diving into the, retail-based REIT industry.
Yeah, so that's going to be exciting. I'm excited to do these REITs together, Lanny. It's something we haven't really talked about too much recently. We've mentioned realty income. We've mentioned Vici recently, several months ago, but it's been a while since we've taken a deeper dive into some of the REITs. So it'll be fun as we start jumping into these three. Do you want to kick it off with the first company here, Lanny?
All right, guys, let's kick it off. Why? Because it's the one company. Actually, I own two out of the three, but it's definitely one position I have within my Roth IRA. We're talking about Medical Properties Trust, ticker symbol NPW. And I know many dividend investors out there own this within their brokerage accounts.
That's absolutely right. Their market cap is currently $9.5 billion. And MPW owns and operates over 400 buildings, properties, not just across the U.S. too. That's what's kind of interesting about this REIT. They're diversified across the world. I mean, from their Google Finance page, they own them in U.S., Australia, Colombia, Germany, Italy, Portugal, across the world. So hey, they're not just stuck being exposed to one market's condition. They have some diversification internationally too.
So there you have it. A nice big healthcare REIT here. Wanted to really focus in on the healthcare REIT space. So you'll see that consistent theme with these three dividend stocks. So guys, they're trading at $15.77 as of the close on, ending July 15th here. AFFO, when you annualize that first quarter, currently stands at $1.48. So guys, you're looking at a 10.66 AFFO to, price to AFFO ratio.
Cheaper than the market, obviously. And what's going to be interesting is because we're all sticking these three companies in the healthcare sector, at the end, we're going to be able to see their valuation compared against one another to see which one's undervalued within this little niche part of the REIT sector too.
Yeah, pretty interesting. When you look at the dividend payout ratio, which again, REITs, would be allowed to, send back out 90% of their taxable income back to the shareholders. So here in this case, they pay a 29 cents per share per quarter dividend. So annualizing this bad boy out, you got $1.16. So remember, they had $1.48 AFFO, they have $1.16 dividend. That payout ratio is about 78% right now.
What's moving to the growth? Their 5-year average dividend growth rate is 4%, and they're building a solid streak of increasing their dividend. They've increased that dividend for 8+ consecutive years.
They've got the streak. Many REITs, you'll find out when you evaluate them, are very volatile with their dividend. At least, with MPW, they're building that track record of increasing that dividend, increasing that passive income back to you, the shareholder. So guys, they've been doing it for 8 years, but for 4% dividend growth, how does that compare with the dividend yield?
It's a lot lower. I was trying to think of a funny way to say it, but I'm just going to get right to it. The dividend yield is 7.36%. It's a banger. It's a banger.
It's not small by any means, but you obviously still get dividend growth with that, and you would expect a little bit higher of a yield with a 4% dividend growth rate.
Yeah. So I mean, I think it's where you want it to be for a REIT. So just to summarize here, the price per AFFO is 10.66, payout ratio 78%, 5-year dividend growth rate 4%, 8+ years increasing dividend yield 7.36%. Lanny, you're exactly right. The yield and dividend growth are right in the combo you want. So just keep that in mind as we go to the next two companies too.
Right in the sweet spot.
Yep, and just so you know, to their performance year to date, quick note, down 32.75% and down 22% over the last 52 weeks. So they're been a tough 2022 because of the impact the interest rates are having.
Yeah, and we'll see if things change with the second dividend stock. Again, the REIT hanging out in the healthcare arena. Peak, we're talking about Peak, Berg. We've owned this company for a long time, back in the HCP days.
I was gonna say, you mean the former dividend aristocrat HCP.
Yeah, long time away from those days.
Yeah, that's when we acquired them. And then HCP, they actually started that trend, right? No, they had a different situation. They spun off a bad portion of their book. So we were left with Peak Properties. I can't remember the exact day, but it wasn't like two companies that are going to shoot on take off. It was like, hey, let's just sweep this one under the rug, get out of here, and focus on Peak Healthcare.
Yeah, they had some issues with the merger. Bottom line is, though, ticker symbol Peak, Healthpeak Properties, another healthcare dividend REIT. We're going to get into the metrics here. This is a $14 billion by market cap REIT, and they recently were trading at $26.22. And the AFFO, you got to think, MPW is trading a little over 15, Peak is trading over 26, but the AFFO is currently looking right about the same.
Yeah.
And that means that their AFFO, price to AFFO ratio is about 17.7, so much higher than MPW right now.
Yeah, isn't that fascinating, Lanny? It's fascinating what is going on. I mean, then again, it's a great stock. I mean, even though they spun off the bad and kept the good, Peak is a great healthcare REIT too. All right, let's slide into that second metric here, Lanny. That dividend payout ratio. Peak's dividend history is very interesting because their dividend currently isn't at its peak because it came down a little bit during the pandemic here. It's now $1.20 per year. So if you take that, divide that by the AFFO, that gives you a payout ratio of 81%.
Sounds like a prudent dividend cut right there to me for Peak, falling from its high of 37 cents down to 30 cents. which means on that dividend growth, it is nothing. It doesn't even exist.
Wah, wah. So let's see what
But Bert, they make it up for the dividend yield, right?
100% Lanny. Jinkies. They have to have a strong dividend yield. $1.20 divided by 26.22. Oh no, that's only a 4.58% dividend yield.
Not Jamie Briggs.
Oh, anyone, not the ponytail and the
Oh, the
glasses.
paint covered overalls.
Yeah.
So guys, you're looking at a stock that's been down 27% this year, 25% in the last year, with a high price to AFFO ratio of 17, almost 18, higher payout ratio at 81%, lower dividend yield at 4.38% with no dividend growth.
Let's just get this one out of here. Go to that third stock. That third company is the smallest market cap on the list. Comparison, remember, MPW, $9.5 billion market cap, Peak, $14 billion market cap. Third company's market cap is $2.78 billion. Laney, who is this third healthcare REIT that we're going to talk about today?
Well, it's a pretty standard name, National Health Investors, ticker symbol NHI.
You know, I feel like the REITs could really use some help with their naming conventions. They're not exactly the best.
No, nor their branding or marketing images, but we won't get into that. Maybe they're saving their money to send more money back to shareholders.
That's fine. You know, I'll go with that. That works. That tracks.
Yep. So guys, they're trading at $60.86. Now they don't report AFFO. They only report funds from operations. So we're using the FFO in this situation, $4.40. So the price to FFO ratio right now is 13.83.
Annual dividends, $3.60. Divide that by the 440. That's a payout ratio of 81.82%, the same as Peak.
The Pikes are the same as the Pikes Peak.
Pikes Peak. Let's look at that dividend growth here. Also similar to Peak. They don't have a strong history of increasing that dividend at all, Andy.
No history of really growing that dividend based on what I could see. In fact, I think they also lowered their dividend during the pandemic.
It is exactly in line with Peak here. So yeah, dividend cut during the pandemic. You're absolutely right, Lanny. It looks like June 2021 was 90 cents per quarter. March 29th was $1.10. So yeah, there you have it. Dividend cut. We solved the mystery of when the dividend cut was.
But the yield is higher than Peak's at 5.92%, albeit not even as high as Medical Properties Trust that actually has the lower payout ratio and the higher dividend yield.
So to summarize, price per FFO, 13.83, payout 81%. They cut that dividend last year. Nothing for metric 3, yield 5.92%. Would you have guessed, Lanny, that this is the one healthcare REIT on this list that is outperforming the S&P 500 this year?
No, would not have guessed that. And, again, I'm kind of floored myself. They're actually the better performer out of the three REITs right now. Pretty interesting stuff. Here goes. So guys, here's a chart of all three dividend REITs. Which healthcare REIT, if you own one, do you currently have in your portfolio? If you owned HCP or Peak, what did you end up doing with that stock? I would love to hear the feedback.
Yeah, I mean, let us know in the comment section too, your thoughts on NHI, if you've heard of them, if you're happy to see them, what your thoughts are with them. And quite frankly, are you one of those dividend growth investors that have been buying MPW? Because we know there are a lot of you out there that have been adding to this healthcare REIT, and you can see why when you're looking at the metrics. It's not a surprise why this is catching some people's attention.
Catching some people's attention, guys. So let us know in the comments what you think of the healthcare REIT space. Also, give us any more feedback, what other stocks to buy there are out there. Keep us all posted. Bert, any other parting words?
Thanks again for all the support, everybody. Let's go. Let's get to financial freedom, brick by brick, dividend by dividend. It's time to roll.
Don't forget to smash that subscribe button, everybody. Give this video a nice thumbs up. That was your boy, Bert and Lanny, the Dividend Diplomats, over and out.